Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Matt Mondoux, and Vince Parrack standing in for Dan Cedar today. So we're going to talk through all of your favorite market-related items. Quietly, the S&P 500 is up almost 8% since the end of April. So quietly or not, we are back to approaching all-time highs in the S&P 500. We want to have a dialogue about whether or not we think that is warranted or if there are some risks, looming beneath the surface. So without further ado, I think I'm just going to jump straight into it. S&P 500 up roughly 8% since the end of April. There's obviously been a ton of dialogue going back and forth between our current administration in the U.S. and other parties outside of the U.S., but the U.S. equity market has seemingly climbed this wall of worry and gotten back to almost where it was in February. Now, I will call out that if we look at the returns by sector over that time frame, there really are only two specific sectors in the S&P that are printing a return or have printed a return above the S&P, and that's information technology and communication services. The other sectors are all below that, with the exception of industrials, which is more or less in line with the S&P. So the reason I'm saying this is because you can take that 8% return as being more or less dominated by two sectors. I'll caveat that by saying it's possible that those two sectors were oversold once the whole Liberation Day news hit on April 2nd and immediately thereafter. But really, I think that's what I want to have the conversation around. Was the initial sell-off on sectors such as information technology and communication services overblown, or has this rally since the end of April been too much too soon? And I think you can rationalize it either way. So I'm curious to hear what Vince and Matt have to say as we get started.
Go ahead, Vince. So my thoughts around it is for those sectors, information technology, communication services, I do think the initial sell-off was a bit much. The tariffs kind of caught us by storm. Market sold off very quickly. A lot of fear and emotion was pulled into it. But I would also say I'm kind of both of those arguments. I do think it may have gotten back a little too quickly. The tariffs, they're on pause, but they're coming back in a month from today. So we don't know what exactly the rates are going to look like, but there's definitely, we're above the point where pre-Liberation Day we were expecting some softer reciprocal tariffs, and we're above that point now. So I think it may have gone down too fast and kind of come back too fast, just more or less driven by emotion, fear on the downside, fear of missing out on the upside. But overall, it's been kind of a volatile ride.
Right.
Yep.
Yeah, it's interesting. Right? This is the ultimate, with the benefit of hindsight, kind of item here, right? I think we all have a feeling that these tariffs may or may not stick, but you ultimately had to take them seriously. Mm-hmm. And I think we see a lot of this in earnings, right? A lot of companies have withdrawn guidance. They have, tariff, non-tariff related guidance. So companies really don't even know yet. Mm-hmm. I think that the markets are taking an optimistic view that something will get done or tariffs will be less than what we originally anticipated. That's clear what the markets are pricing in. So that's what needs to happen if we're going to remain at these levels. If we get some reality that's differing than that, if things escalate, if trade deals do not materialize, then yeah, absolutely, we're too high. But here and today, the markets are saying this administration is willing to. They're not going to be so hard-lined that they're going to, cut off their nose to spite their face quite yet. Mm-hmm. We'll see.
Yeah, and I will say, so in terms of, was the sell-off in spaces like communication services and information technology too much too soon? I do think you can make that argument, partially because when you look at when this all flared up, the tariffs are designed around goods, more or less, right?
Yep.
And so when you look at sectors like tech, like communication services, those generally speaking are pretty heavily services oriented. So with the exception of maybe your NVIDIA, maybe an Apple or an Amazon, yes, those are somewhat goods related. But otherwise, I really would actually expect in a tariff-driven environment, firms in tech that are service-oriented to perform pretty well. Mm-hmm. And so I do think there was a very large element of throwing the baby out with the bathwater as it pertained to the selling pressure that initially happened post April 2nd in sectors like tech, like comm services. And so to see some of those same names and those same sectors start to rebound very rapidly as negotiations have started to ensue and have progressed more or less, it's really not that surprising to me. And I think I can rationalize that. Now, where I struggle with is that, just like Matt said, you kind of had to take Trump at face value in terms of putting forth these tariffs, the language around them. You have to take them at face value because, I mean, he literally put them in place. Who are we to question that, especially when they've gone into action? Who are we to expect them to be basically pulled back for 90 days almost immediately? The fact that that level of uncertainty does still exist, even though we're in this exemption period and likely we'll be getting information flow over the next month that will impact the markets either positively or negatively, I do worry that for some market participants or just the market at large, that exemption period has more or less put the whole tariff conversation out of sight, out of mind. And I don't know whether or not that's rational fear or not, but it is something that I'm kind of worried about right now.
Well, and let's take an example. Let's use Apple as an example. So Apple, biggest company by market cap in the world up until recently. Mm-hmm. Apple's 20% off their 52-week low, but they're also 20% off their 52-week high. And Apple had to respond to the tariffs by proposing moving some infrastructure to India. And the costs associated with developing that infrastructure are going to be significant. Mm-hmm. I've listened to some people who've said it's not going to be a stretch to say that iPhones may be somewhat more difficult to come by over the next few years as Apple withdraws from China and starts to increase production in India. This is no small feat. And you can see that in their share price, right? So we're talking, Microsoft's back near all-time highs. NVIDIA is certainly just a few percent off all-time highs, but Apple is the other case. And, you can see if things get bad, how it can be reflected in share price.
Yeah. Yeah, and I think that's all fair because to me, the ultimate pain point of this entire trade or the tariff negotiation process, I mean, it all boils down to the impact on supply chains and prices. Mm-hmm. Because we all saw what happened in 2020 where you basically shut down global supply chains for a period of time and the ensuing impact on prices that consumers experience. So you can think of what's going on, or at least what was proposed from a tariff perspective, as an actual engineered version of what happened in 2020, which would be somewhat catastrophic at the most extreme levels for both the U.S. economy and otherwise. But when you have it impacting a firm like Apple, who is so far-reaching, like Matt said, up until just very recently, they were the largest company. That type of stuff does scare me because regardless of whether or not Apple ends up feeling the burden of those higher prices and has to shift manufacturing, the perception in the markets right now is that that's a likelihood. Maybe not 100% certainty, but there is a very large possibility that the cost of iPhones to produce them will be going up. The price that consumers will have to pay will be going up. And oh, by the way, the availability, the sheer number of iPhones that will be produced will be a little bit lower. Mm-hmm. So the impact that Apple as a company can have on broader market indices should not be understated as well. Right.
Yeah. And it just shows kind of the alternate reality if things do go sideways or if companies start to need to shift production. There can be some significant ramifications from a price standpoint.
Right. Yeah, and maybe even just looking at the other end of the spectrum in terms of sectors that maybe have not performed as well within the rally that we're just looking at from the month of May up until month to date in June. you look at companies that fall in consumer staples, for example. So it really has been, we've flipped from this kind of equity protection focus that we had basically immediately post-Liberation Day until the end of April, where sectors like consumer staples that are perceived as defensive because they're making toilet paper and toothpaste and deodorant, that can be attractive in a defensive manner in a kind of uncertain economic environment. Shares, generally speaking, at least as it pertains to the S&P 500 consumer staples, are positive, but albeit only by about 1%, 1.5% versus the broader index at 8%. So it's like you can very clearly see the risk tolerance shifting back into the market. Mm-hmm. And again, that whole out of sight, out of mind argument, I do think holds some weight, because it's not like there's not really an ability that I have to say that when we got readings from corporate America on first quarter results and the forward outlook for those companies, it's not like there was an overwhelming aggregate positive messaging that happened. There was just a lot of throw your hands up and say, I'm not really sure. Yeah. And so I'm personally not sure how you can have confidence to that degree in the equity market today versus April 2nd. Again, that's a more pessimistic view, but it's just trying to play devil's advocate, because I really am not sure what fundamentally has changed in a large way.
Right. It's not as if the plate, politically speaking, is getting any less full, right? Tax bill needs to pass, perhaps debt ceiling, while navigating tariffs. I mean, there's a lot to be done. Right. A lot to be done.
We're going to take a quick pause for a small break, and we'll rejoin the conversation momentarily.
Are you approaching retirement, whether it's 2 years away or 5? At Blue Chip Partners, we understand that this next chapter can bring a mix of excitement and uncertainty. Transitioning from a regular paycheck to relying on your savings is a big adjustment, and without the right guidance, it can feel overwhelming. But retirement is about more than just money. It's about peace of mind, spending with confidence, and living without regret. That's why, as fiduciaries, we always put your interests first. Our experienced advisors deliver proactive, personalized wealth management that aligns with your unique goals. Let's build your retirement plan together. Take the first step and schedule a consultation with Blue Chip Partners, your trusted partner in retirement and beyond.
Okay, welcome back. So shifting gears a little bit to over to the economic side of the equation. While there really hasn't been that meaningful of a change in terms of the economic standing in the U.S., I mean, you look at the labor market, which continues to show signs of healthy progress, albeit a little bit of softening. You haven't seen an inflation flare up. You haven't seen a cratering in spending. But we are starting to see some things crack and bubble up underneath the hood. So I want Matt to just provide some brief intel on some of the things that we are watching right now and will be watching as we go forward to see what is the economic impact of some of this tariff activity.
Yeah, when it's an interesting point, because a lot of times we get asked by clients, wow, this must be pretty crazy. How are you dealing with tariffs? And I think a lot of the focus, rightly so, on individual investors' attention is, well, what's in the financial media a lot, and that is tariffs. So we're talking tariffs, but tariffs aren't necessarily what we're going to look to assess the underlying health of the economy. One of the more significant areas of the economy in this country is housing. And we can learn a lot about the health of the economy through housing. Oftentimes, new home sales are a leading indicator of forward economic outlook. And this is all really early, but we are starting to see housing slow down a little bit. And what I mean by slow down is, we're looking at June 9th updates. Inventory's up 32.2% year over year nationwide, which is interesting. I mean, it's all very low levels. So this isn't we had a ton of inventory, now we have more. We had very little, right, but we're getting more. You're starting to see that pick back up. You're starting to see some pretty soft comments from home builders in their earnings reports. The Toll Brothers CEO came out and said very, very bluntly, spring was not good. Now, it doesn't mean it was bad, but it wasn't good.
Right.
And these things are, you start to kind of pay attention to. And if we start to build a trend in housing of data kind of consistently not meeting expectations, that's when you do start to question, okay, what's going on with the economy? Do we need to get a little more defensive? What are the actions to take?
Yeah, and I think it's very easy to rationalize why something like inflation hasn't changed meaningfully since some of the tariff conversation kicked off, because ultimately the actual implementation of those tariffs, at least as they've been discussed, hasn't really happened yet. So you can kind of cross out inflation as something that will give you an accurate read on the health of the economy post tariffs. But when you think about, as Matt said, something like a leading indicator such as new home sales, the ripple effect that new home sales can have across the economy is pretty dramatic. I mean, you think of, just as an example, a company like Home Depot that is being used to help build those houses and stock those homes eventually. The fact that you have less people looking at buying new homes, that can tell you other information outside of, oh, I'm just not ready to buy a house yet. So you can kind of read the tea leaves, and there are other examples of these leading indicators, I would say, that are worth paying attention to at this juncture, because quite frankly, some of your traditional indicators, like the ones in the labor market we get from the jobs report, or inflation, or even just retail spending, it's hard for me to have a lot of confidence in them right now, because it's almost like they're painting a picture with stale paint. It just is not incorporating the environment that could happen. So I'm not saying I'm completely disavowing or paying no attention to them. I just think that if you want a more accurate read, you have to start getting a little bit more creative and looking at some less traditional, less headline items.
Yeah, and homebuilder stocks are down, between 35 and 40% from their 52-week highs.
Right.
So they've priced in slower building conditions. Now, I want to fully say, we're not calling for a housing bubble. We're not calling for a housing bust, but it's a more economically sensitive area that you can watch and start to say, okay, is there a trend here? Are we going to enter some type of, slowdown,
right.
The dreaded R word?
Yeah. Well, and I think the reality of it is, again, you were very clear that this is a relative measure when we're talking about inventories increasing. Yes, it's off a low base, but they are increasing, and that's information. I mean, we looked at this data earlier this year where when you do get a pronounced detraction in new home sales, the forward returns are not very good, at least for the S&P 500, both cap weighted and equal weighted. We're nowhere near that level yet. But again, we want to start paying attention to some of these indicators, some of these items before we get to that point, because it's important to build an action plan well before it's actually time to act.
Right. And that's what's interesting. I'll read this excerpt from this report. With the key stories for existing homes is that inventory is increasing sharply and sales are essentially flat compared to last year. And the sales in 2024 were the lowest since 1995. That should translate to price being under pressure.
Right. So obviously a lot to unpack as we monitor the S&P 500 and other equity markets and fixed income markets as they ascend back from some depressed levels. But for now, we're going to call it a wrap, and we look forward to speaking with you all again soon.